Welcome to Oregon Cash Flow Pro. My name is James Barber. We're on to question 3 of Matt Allen's questions. If you want to check out the answers to the other 2, you can check out those videos right here. And in this video, we're going to be answering his question about moving money between life insurance policies and other assets and investments, as well as going through the wealth pyramid. So let's jump right into his third question. After his first 2 questions, he continued, what do you think of the strategy that has some traditional investments, some whole life, and some IUL, and use the whole life as a catch bucket and refill it out of your traditional investments or the lump sum that you're taking out of an IUL? In general, I like the idea. Now, this question is a little bit confusing because it kind of bounces around a little bit, but to begin to answer it, I'm going to go through our wealth pyramid, and then we'll talk about how we can move money to help maximize this strategy that he's asking about. So this is the wealth pyramid I created, and it's basically meant to represent a stable approach to building wealth. Now, you don't have to follow this pyramid, but the reason I created this pyramid is because we want to have a nice, solid financial base with which to build our wealth. If we start off with the inverted pyramid, where you have very risky investments as the core of where you're putting your money early on in your life, it's likely to topple over in the case of emergencies or stress to your finances. So that's why we have this in a pyramid, and why we use that. Pyramids are very stable. We've got our solid foundation. As you can see, our solid foundation that will allow you to maximize your financial freedom, take advantage of future investment opportunities. Oftentimes, people will mistake high risk with high rewards. And in doing so, they neglect the safe building blocks of a solid foundation for those riskier ventures, often leading to financial collapse. Let's briefly go through each of these levels of our pyramid so that you can get a better idea of what makes up a solid financial base and hopefully identify if you need to help stabilize some of these things in your life. So the base of our pyramid consists of stable sources of income and safety from catastrophic events. These combine to provide stability and financial protection. Secure these before moving up the pyramid for maximum financial security. You can see in the base, it's made up of our safe financial holdings. Shelter. Now, whether you own or lease, reliable shelter is critical for your financial stability. Without a safe place to live, you risk employment, asset loss, stress, fatigue, mental and physical health. It's kind of a big deal. Savings. You should have 3 to 6 months of savings that are easily accessible in emergencies. This includes a bit of cash for things that require an immediate need in case banks are closed or inaccessible. Maybe 3,000 to 5,000 in a checking or savings account for situations that might require access to funds within 24 to 48 hours. The remaining emergency funds should be in something that's highly liquid, interest-bearing, that you can access in, say, 3 to 10 days, such as high yield savings accounts, money market accounts, no penalty CDs, and cash value life insurance. Insurance. Lack of insurance in a tragic situation can set back a lifetime of prosperity. Ensure that you have the bare minimum of coverage and strive for maximum coverage. There are limits to what you can insure. Don't just ask for the cost for minimum coverage. Find out the cost for maximum coverage as well. It might actually be a better value. There's many different types of insurance that falls into this category. We've got homeowners and renters insurance. That type of coverage is critical. Fire, theft, and injury can quickly devastate your financial future. While you're at it, add an umbrella policy. Auto insurance. It's basically mandatory. Check to be sure that your coverage is adequate for your needs. Often overlooked is uninsured motorist levels and overall liability levels. It's usually best to get as much coverage as you can. Health insurance. Health issues can derail the best laid plans. Medical bills are a leading cause of bankruptcy. Be sure you're prepared for unexpected injury and illness. Life insurance, whether it's insurance on you, your spouse, your business partner, your employee, or a loved one, life insurance provides living benefits and death benefits. A properly designed policy can be used throughout your life to accelerate the growth of your wealth. Examples include pension maximization, personal banking, flexible savings assets, supplemental retirement income, estate planning, and of course, tax advantages. Next, we have pension and income annuities. Pension and income annuities are guaranteed lifetime income streams that provide income for the rest of your life and sometimes life of your spouse as well. Employers provide pensions. They're slowly disappearing, with only about 7% of employees offering them now. Income annuities are products offered by insurance companies. And of course, we have Social Security. Social Security is a lifetime income guaranteed by the federal government. How much you're going to get, that may change. But at this point, we don't expect Social Security to completely go away anytime soon. Moving on up to the next level, we've got our conservative investments. Level 2, I call that the opportunity zone. Once you have your base covered, you should explore opportunities to invest your extra money in conservative, cash flowing, and or tax advantaged assets. This level's assets should be tangible, relatively low risk options that perform well over the long term. View these assets as if your future retirement depends on it. These will include 401k or 403bs. Those are employer-based and controlled tax advantage retirement accounts. It grows tax deferred. It is taxed as earned income upon withdrawal. IRAs, individual retirement arrangements. Those are individual-based and controlled. It grows tax deferred, just like the 401ks, and it's taxed as earned income on withdrawal. It does generally have greater flexibility than a 401k or a 403b. Next, we have Roth IRAs. Those are individual based and controlled. It uses after-tax funds and grows tax-free. I'm a huge fan of the Roth IRA, if you've noticed in any of my other videos. Then we also have real estate. Real estate is a generally stable, low-risk investment. Tax advantages through depreciation and 1031 exchange to defer capital gains are available, and there are cash flow opportunities. There's probably thousands of different ways, maybe tens of thousands, that you can participate in real estate. Moving up, we have level 3. This is moderate to aggressive. Now, these are just samples of what might be in each of these categories. These are not all inclusive, okay? Level 3, I call this one the fun zone. After your retirement goals are met, you can branch out with your wealth building opportunities. These assets should still be tangible, but you're free to go for short-term gains, explore alternative investment options, and any other opportunities that arise. These might include stocks. With stocks, your investment are at the mercy of individual companies. You'll want to be able to ride out downturns. Don't tie up funds you'll be forced to withdraw at inopportune times. Royalties, that could be a good way to generate long-term cash flow. They may or may not pan out or be consistent, but it can be fun to own a piece of a popular song, movie, or play. Life settlements, those are guaranteed to pay out eventually. The risk is in tying up your funds for an unknown length of time. Returns can be worth the wait, though. Other tangible investments, meaning you are investing in something of substance that doesn't just disappear or lose all value in an instant, like starting a business, art, commodities, and other things like that. The key is tangible, as opposed to things in our last level of extreme risk where they're not tangible, meaning there may not be anything to it. The value of it is strictly based off of what somebody may or may not want to pay. It could be an idea, it might be an NFT these days, whose value could go completely to zero tomorrow. So that brings us to level 4, extreme risk. If you've covered your bases, prepared for retirement, and successfully explored the fun zone, there's likely no reason to actually climb up to level 4. Extreme risk does not equal high reward. It most often just leads to losses. You might want to just consider donating to a charity instead. But a lot of people have fun in this area as well. And it can certainly be very lucrative if you find the right investments. But for the most part, probably not going to need to delve into anything that puts your hard-earned money at an extreme risk. So that's our wealth pyramid. Now, the question asked by Matt, what do I think of having some traditional investments like whole life, some IULs? Now, he's referring to things here in our base of our pyramid, and use the whole life as a catch bucket, refill it out of your traditional investments or lump sums that you're taking out of your IUL. So what he's talking about is you build up your cash value in your life insurance policies, which is part of our base here. Love this idea already. It's what I do in my personal life. You borrow from that. So you're not going to borrow all of it. You're going to borrow a safe amount, and you're going to direct it towards some of these other investment opportunities. So you do that, and then as those investment opportunities pay off, you can pay back the loan, and you're refilling this bucket at the base of your pyramid. Now, the reason we might want to do that, the reason we like this down here, is because our cash value life insurance, it can serve as multiple pillars of the base of this pyramid. We can have our savings inside of it. It can meet our death benefit needs. It can meet our living benefit needs, our long-term care needs. We can use it as a pension, meaning we can turn it into lifetime income. So while it's here serving multiple needs, we can also access it in order to move our way up the pyramid. So I love the strategy of doing it this way. This is actually what I do in my personal life. The first thing I do is max out my insurance policies each year as soon as I can. From there, I take my money out of that. I fund my 401k. I fund my Roth. I make payments on real estate. As I'm able to, I put more money back into here to help pay back those loans. And it's available for me to borrow again. I borrow it. I buy stocks. I buy options. I use it to trade. So I definitely think that you're on the right track as far as that goes. Now, the only part that was confusing about this question was the lump sum that you take out of your IUL. I don't know if he had something specific in mind as far as that goes. So hopefully that ends up being a full answer to his question. And we will be back in our next video with question number 4. And there's a quick preview of question number 4. Thanks for joining me today. If you have any questions, put them in the comment section below. I try to answer every question that comes up, whether it's right there in the comments or if I do its own special video. If you're finding value, hit that like and subscribe button, and we'll see you next time. Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.